Matt Fabian here to help us out, Municipal Market Advisors. First of all, how much do you disagree with Ms. Whitney, or is there something in there that you find has value?
Well, I mean, she does make a lot of statements that the industry itself has been making for 5 or 10 years, right? I mean, long-term pension liabilities, debt liabilities, Medicaid in particular will begin to drag tax money away from economically productive pursuits, and that it will be a long-term drag on economic growth in the country, right? So that's a very common thesis to be talking about. Going beyond that, pushing it into saying, and equals defaults. I just don't understand it. I just don't understand the connection, how she gets there.
We saw Hawaii downgrade. There are this, that, and the other, but when you get to the size of the defaults and the scope and the reaction to her 60 Minutes interview, can you help our viewers, particularly those at home, with savings? There's got to be defaults out there. There's always defaults.
There's always defaults going on in the municipal market, right? Right now, there's about 250 different credits, that are in some kind of payment default. Right. But these are, almost 95% of these are non-rated, smaller, high-yield-oriented deals that are not typically purchased and shouldn't be purchased by individual investors. They're bought by high-yield funds who, specialize in those kinds of deals, land speculation districts, park districts. We've talked about this before. I mean, that's the baseline. In munis, there's always a baseline of defaults. Small projects getting into trouble, big projects that that are going to fail regardless of the economic scenario, and then now these real estate deals.
The distinction that she brought today is she looks at the big view versus your more narrow individual security view is in this chart. Let's bring that up, folks. This is a really, really important chart. This is nominal GDP. Call it the animal spirits of the nation, and that's the average nominal GDP back 20 years. All that blue above the line is the good feeling we had. We've come back, but Matt, we really haven't come back. Is the distinction here, whether Ms. Whitney's right or not, going to be the future of that nominal GDP? If we get a soft economy, it may tilt towards her. And if we get a good economy, you're right, Dan Clifton's right, everybody else is right.
I mean, I think that longer term economic growth is going to be slower. I mean, my firm is fairly bearish on economic prospects. One of the reasons is that there's all kinds of entitlement spending and others that are going to drag money away from social services, education, infrastructure, finance. It's a real pressure. We have to come up with alternate sources of funding in the country.
Just quickly, will the default number go up from your 250?
Probably down. Probably down.
It'll improve.
I mean, I think because most of the deals, there has not been a large influx of new deals over the last 6 months. So the outstanding deals at some point will begin to get restructured, and then so the total number should begin to fall. The muni market is in the weeds. You have to understand the legals, the documents. These things are very carefully created and constructed by credit analysts like myself to make sure that default doesn't happen.
Okay. I want to come back and talk about that. I'm going to write that down then. So, Matt Fabian with us as we talk municipal bonds. You're a credit analyst. Is Meredith and her team, they're more known for their equity and bank work. Are those two discrete sets of analysis, or can you go over and look at equities and she go over and look at bonds?
I wouldn't presume to look at equities because I don't know much about what I'm talking with equities. But it appears that they are completely different. From the recent connection between the two. You
made a point on our break that Ms. Whitney makes a big deal about pension liabilities, obligations, state of New Jersey, gloom there, and you say, yeah, that's a big deal, but it's child's play compared to other worries.
Medicaid, Medicaid is a huge percent of the state's budgets, getting worse, right? With the healthcare reform between now and 2014, Medicaid responsibilities grow tremendously.
Then will there be defaults because of that?
No, I mean, it's just a way of, finding the way to service the population. It'll be, spending cuts elsewhere or, tax increases. It just the cost related to default with respect to default on bonds versus the benefit. Remember that debt service on bonds is 5 to 10% max for large state issuers. So what do they really save? They're going to bring a whole world of cost down on themselves for a small gain.
One of the presumptions here, which many of us have known for over a decade, is you get the first year you use up your rainy day fund. The first year, it's easy to raise, well, not easy, but you can raise taxes. You can go through that first round of layoffs. Do you presume that given average to tepid nominal GDP. We'll see a repeat of that. And our states and locals, are they able to do that? Are they able to repeat the agony that they've done already?
Most have already used their normal operating reserves, and frankly, as the budget has proceeded, they first blew through 2 or 3 years of budget gimmicks and one-time measures. Mostly they're through that now, and they are doing structural improvements, raising taxes, cutting spending, moving services down to the local level. So going forward, I think that states will get better. It's going to be a difficult few years ahead for sure. And by few I mean maybe 5. But
right.
but we're through for states. We're through the worst of it.
Well, here's the key. Let's show this chart, if you would, here. There's still faith in munis. Still faith in munis. This is a Bloomberg fair value, AAA GO yield. And then that chart's a little nudgy there. It's supposed to come down a little bit. You can see it's edged down slightly from like a 350 down a little bit more. There hasn't been panic in the markets, has there, even though the flows have come out of the markets?
It's funny because, I was just talking about this morning. The principal way that the muni market has of communicating with investors is on their bond evaluation, right? So if people sell their bonds, the evaluations go down. The implication is that there's trouble and that there's defaults coming, right? That's what happened in November and December. It's the problem with our market is that we don't have a better way to communicate that the credit situation is difficult, it's rocky, but the market has been built to survive this, and it's a technical pricing factor, supply and demand imbalance. It's not a default.
Okay, we have to leave it there. Matt, Fabian, thanks for some clarity on this and some pushback. We love this debate, folks. We try to bring the debate on whatever the topic.